we've been watching the VIX pretty closely. The futures going into backwardation over the last couple of weeks, and this week on Friday it's back to a normal curve, but just barely. So it's a contango situation now where each month contract is priced slightly higher as you go further out the futures forward curve. And so we wanted to take a look at, well, why is it that we went from a VIX in the mid-20s to a VIX in the mid-teens so quickly, despite the market still being pretty volatile and frothy.
Can you explain how the VIX, and whether it's in contango or backwardation, impacts SPY prices, impacts the stock market?
Yeah.
I think it'd be good to like.
Sure. So like a normal market where it's the stocks aren't all that volatile. There's not a big risk of a crash. The market isn't anticipating a crash. You're going to see the term structure on the VIX. It'll cost you more to insure the further out you go. So like if you want to buy what I would term crash insurance, buying puts or whatever, or even buying volatility, the VIX futures, it's going to cost you more the further out you go. However, if the market is pricing an imminent crash, it's going to cost you a whole lot to insure right now. And that's what we saw when the VIX went into the backwardation is people wanted crash insurance and they wanted it right now. And we saw the put to call ratio spike up. I think equity put to call ratio was almost 1, which means that for every call that is purchased, there was a put that was purchased. And so that's a pretty defensive stance. A lot of literature would suggest that when the put to call ratio gets to around 1, a value of 1, then you're looking at the height of a panic. And we didn't quite get there, but if you look at across all puts and calls, not just equities, then I think that ratio did get well above 1.0. So anyway, so it has to do with how is the market pricing crash insurance, and so that's a forward-looking number. It's people are anticipating what they think is going to happen, or another term for it is implied volatility. What that means is what do market prices imply about the expectations that market participants have about what's going to happen with volatility. So what we're looking at right now is realized volatility or historic volatility. And the way that we are illustrating that is we're using ATR as a percentage of the closing price. So the ATR is average true range. And so over a 14-day period, what's the average height of a price bar or a trading day? What's the range of a trading day, including gaps? The ATR includes gaps in the calculation, if there is a gap. So if the market is up 1.5%, then that's not the ATR. The ATR looks at the full range, the high and the low, plus any gaps. So that's how the number is calculated. And so when we divide it into the closing price, we're basically normalizing that bar height across the entire history of the SPY back to 1993 or whenever, I guess looks like March 1993 at inception of the SPY. So these numbers are normalized, and the conclusion here is that currently we're at basically a 1.5%. We're at 1.47, very close to the lifetime average of 1.5% range on the daily bars for SPY. And the standard deviation is 0.82. So One thing I want to point out, though, is the reason it feels like the market's gotten very frothy is because, for one, we're in a bull market. The market's up a lot, and as you can see here in this region, for the last couple of years, the volatility has been very low, averaging around 1% true range on the bars. Another period that is similar is Alan Greenspan's Great Moderation, the 2004 through 2006 period, where interest rates were dropping steadily. And right now we're in a climate where the short-term interest rates are just basically pegged at zero, and that era began right around in here in 2009, early 2009. So near the bottom of the market. And they've been pegged very low ever since. And that's something we can maybe take a quick glance at later. That's a whole another huge topic of its own. But anyway, what's worth pointing out here is when we've been watching the rise in the VIX, and we're seeing this sort of changing environment. This line right here shows it. And we're raising alarm bells because the climate for investors and traders is changing. And so if you look at sort of these glory periods for the day traders, look at here like the late 90s, the whole .com thing. Lots of this is a period of opportunity for the day traders. They love it, and you've got a 2% and higher ATR on the SPY. Another period, the day traders really loved the 2008 crash. It was a period of opportunity for them. They can take the money and run on their day trades, and they've got huge range in the bars that they can try to capture. So they're not making money on every trade, but that it's a period of opportunity. It doesn't take as much leverage to get as a big gain.
Now, in terms of absolute magnitude back then, I remember days 400, 500 point moves in the S&P on a daily basis during the volatile period in 2008.
You mean the Dow?
I mean the Dow. Yes.
Yeah.
Yes.
Like there was a big headline like 777 points down was like one of the big shocker days.
Right. Well, I just did some quick math, and today we're up about 50% since that period, since the highs in the S&P. In terms of S&P, we crested we hit what, 2,000?
Right.
Came right up to it. The high back then was about 1310 on the S&P.
Okay. Right.
So we're about it's a little less than 50% more. So for that kind of volatility to come back in, the absolute magnitude today would be 50% higher than those 500 point swings. You're talking about 750 point swings.
Oh, right. Like the point numbers on the Dow.
Yeah.
If we were to see these big, 7% ranges, where your average day is moving, 5%, 6%.
It would be insane.
In the Dow, yeah, it would be huge point moves. Yeah, it's kind of funny. The 1987 crash, the point move there, I think it was maybe 400 points or something, which was absolutely huge at the time. But like today, it's not anywhere near as shocking. And interestingly, I think the height of the Dow in the 1920s bull market, the Roaring 20s, the height of it was 400. So the whole thing was 400 points. And so anyway, that's a good reason to try to normalize these numbers so that you've got something you could compare the history against what's happening right now. So these really are very tame periods in here, and I guess a really important point is that you need to adjust what you're doing to fit the climate that you're in. And so a way that you can do that is having a really good way to measure it. And so here what we're showing is, we're offering this as a way that that people can use to track what kind of climate they're in. This is something that we use, and it's been pretty helpful. So anyway, I guess that's kind of enough on that for now. But it's a fun topic. So maybe we're in a climate change. It could be happening. So coming over to here, just take a quick peek at the Nasdaq 100 list, and I want to sort by this week. What's the big movers in the Nasdaq? So here's the big up move. TSCO. What's the symbol for that? CELG is Celgene. So I mean these are big gains for the week. 16% in Celgene. TSCO 20%.
Tractor Supply Company. TSCO.
Wow, interesting. Okay, there's Yahoo. O'Reilly. I wonder if that's a theme here. Tractor Supply, you say?
Mm-hmm.
And we've got, is this O'Reilly Auto Parts?
Yep.
ORLY? Okay. Yahoo. All right. I love Yahoo. Yahoo Finance. Good stuff. ALXN up 15.5%.
That's a pharmaceutical stock.
Pharmaceutical. Okay. So let's look at the big down ones. I'm just going to reverse the order on the sort here. Amazon. There it is. Biggest loser on the week. So, and all of that happens actually up heading into earnings, I guess. And then, and then down, 8% on Friday? So
8.3.
So down 5% for the week.
Yeah. Looks like they're going to be $40 million short this year. That's what they're projected to be.
Yeah. So you were talking earlier, like let's put a little perspective on this number here. A $40 million loss.
Well, Amazon's like
they're reporting.
Correct me if I'm wrong, but I think it's the ninth largest market cap in terms of market cap. The ninth largest stock on the Nasdaq. It's 132 billion. They lost 5% of that over the past week here, but they still got 132 billion dollars worth of market cap. 40 million bucks. I think at $287 a share, if they were to cover their losses by issuing more shares to pay the bills, it'd be like 150,000 shares. But their volume is like close to 20 million a day.
So a drop in the bucket.
A drop in the bucket.
Yeah.
Everybody's freaking out. I mean, Amazon's never made money in the history of its existence. And another year is going by where they're not making money. And I tend to think, so what? They're going to be around. They're going to be going for quite some time. They're not going away. Okay.
So I think DTV is probably DirecTV. So that's here near the bottom of the list too. And I mean, it's just this is how big of a tear the Nasdaq was on this week, where your third biggest loser in the index is only down like less than 1%. I think CTXS probably Cognizant. Is that Cognizant? Let me check.
Citrix.
Nope, Citrix Systems. Okay. So kind of a theme here, these like digital services in the bottom of the Nasdaq. ISRG, that's Intuitive Surgical.
Mm-hmm.
So medical devices, which that's kind of interesting. This has been a really strong sector, the medical devices for this year. We can show a little more on that later. Vimple, this has been pretty weak this year. So, okay. Anyway, let's move on. Well, I do want to come back a little later to the Nasdaq, and what one of the things that we wanted to review is the Nasdaq index market top in 2000, and kind of compare that to what's going on in the S&P 500 right now, because the magnitude is less, but there's some similarities. So let's do like a little bit more top-down analysis, and then we'll come back to that. So I want to flip over to a macro ETFs basket here, and I want to look at, for the month of October, what's going on. So I'm going to do a performance sort here. Let's look at the best macro themes. So Turkey plus 9%, home builders plus 7.6%. IYR, this is a real estate ETF.
I find this very interesting that these are at the top.
Yeah.
The housing market here has been really on a tear.
Yeah, that's true. So there's definitely a theme here, and I love seeing this when we do this top-down analysis, that these themes kind of emerge. So what about this? What if we could combine it? We could get the real estate in Turkey. Right?
I don't know if it works that way.
Yeah,
but it's interesting because the builders are up as well as real estate. I look at that as new construction and existing property.
Yeah. Now, right? Some of what's in here is mortgage REITs, but that's not the whole thing. It's apartment complexes. It may even include some commercial real estate. Some of the holdings in here,
but it's existing.
Yeah,
it's all existing construction, whereas the builders are focused on new construction or reconstruction.
Right, and so I want to look at a quick little comparison here between these two. Like these normally have very different profiles. Like the volatility on ITB much higher than IYR, and it is higher up in the list. But let's look at some stats here real quick. So first of all, which thing has a longer? So ITB from May 5th, 2006, and IYR goes back to 2000. So let's use the start date from ITB, and so we can do a couple of little comparisons here real quick. So let's look at the Sortino ratio on ITB. Since inception, it's down. Okay, so it's got a negative Sortino. When we look at IYR, over this same time period, it's up. I mean, but just barely. So similar stats there. But what about like downside deviation? We've got almost 1.9% on IYR, ITB 1.78. So I guess pretty comparable. But I mean, this wipeout here, this housing wipeout that happened in from 2006 to 2009. I mean, IYR just not quite impacted in the same way.
You know what it feels like? It feels like this is reflecting a change where people, instead of buying a new house, a new freestanding home, they're moving to an apartment. I'm kind of internalizing it that way. That's what this feels to me.
Interesting. So I think ITB even includes like Home Depot maybe also. Okay, let me turn off that portfolio there and just show these two side by side. So this is kind of what I'm talking about. Like this epic collapse in ITB far outpaces the IYR collapse, and I mean this collapse. This is just a financial crisis coming in and hitting this, whereas this thing, it's a little different. There's something else going on here, and it didn't even really stage the same kind of recovery that the stock market did. So the fact that like the recovery came later in the game, and it was a big increase when it came, and that's been pretty sideways since.
I wonder if that recovery coincided with a loosening of the mortgage requirements.
That's a good point. It could be, but again, this is with new construction. But you know what? That does make a lot of sense.
I have to check the historical context. I don't know when
because exactly. I mean, people have to borrow. Well, people typically borrow to commission a home to be built, right? So if that gets easier to do, then it might make sense. that we would see, this rise.
And just recently, they have loosened the requirements, and that's what I blame on the recent spike in prices in our area, and potentially here on the ITB.
All right, so let's go back to our October analysis here. October 2014. And we've still got the sort. So biotech, XLU, this is utilities. So as far as the spider sectors, utilities are the top performer in October of 2014. And this is a really important point for us. One of the things that we put out a tweet on this month, this week rather, is XLU. It's up 5% for the month. It's up like a lot compared to other stuff. So, you know what? Let's actually look at just the spider sectors here real quick. There we go. And I'm going to sort these for the month. And we'll come back to the other thing. So this is utilities in first place, up 5.3%. Consumer staples in second place, up 1.8%. And then XLV is healthcare, up 1.7%. And then I'm just going to skip to the bottom of the list now. So despite the big rebound over the last week and a half, energy is still at the bottom of the list, and it's down 5.5% in October. And this is the big companies in XLE are getting hit hard by this as well, not just the little ones. So that's really interesting. And we've got banking kind of in the middle here, the XLF, XLB. You know what? The materials ETF down 2.5% for October, and then the one down after that is XLK technology minus 1.3%. So what I would think of as maybe the stalwart sector, XLE, down the most, and what you might like to see leading a bull market, XLK, the technology sector, being down for the month, not a good sign. So, and to put this into context, I'm going to show TLT for October, and you'll see kind of where treasuries fit into the mix here.
Well, it feels like there's a flight to safety here with utilities,
exactly,
and consumer staples.
So treasuries up 2.4%. So it would fit right in there under utilities. So there's a defensive posturing from institutional money. So let's go back to our macro workbook here and see if there's anything else interesting. Yeah, I mean here's treasuries in the list. There's about 90 or 100 things in here, and treasuries is maybe about the 12th position in the list. So pretty interesting. Let's look at the bottom of the list now. I'm going to flip the sort. I'm going to do an ascending sort. FCG. This is a natural gas ETF. Oh, and look, there's natural gas. The commodity ETF. So the FCG is natural gas companies, and UNG is the commodity. So this ETF has a pretty poor lifetime track record, and a big reason for that is they roll. And here's USO. The oil commodity ETF has a similar issue. you're basically paying the market to store the commodity for you with UNG, and that's the contango roll. Month after month, normally, you have to pay just slightly more per contract, and so you, with the same amount of money, you get less contracts, and so there's kind of an erosion in the underlying amount of contracts that they can hold. So that's one thing. But you know what? That doesn't explain UGA so much, because we don't really see much of contango impact in UGA. So it's more than contango going on here. In fact, I'm not sure that oil even is in contango right now. So despite that, USO is still at the bottom of the list. IEO, I think this is oil and gas exploration ETF. So let's just take a quick peek at this. Yeah, oil and gas exploration ETF. Here's the junior gold miners. TAN is the solar ETF. XLE is the energy spider sector. So there's very much an energy theme here at the bottom of the list. And I do want to go into one interesting detail here on the GDXJ, the junior gold miners, is oil and energy is an input cost to production for mining. So declining oil price, it may also imply less demand for commodities, but it also means that their cost of doing business goes down. So there's kind of an interesting dynamic there with the gold miners. And here's GDX, the regular gold miners, also pretty near the bottom of the list for performance. So
how about transportation? Do you have transportation on it?
Yeah, let me sort it the other way.
Transportation historically has kind of swapped volatility with energy.
You're saying there's like a counter, or it's a inverse correlation relationship?
Sometimes.
IYT. This is the Dow Jones Transport.
Historically, IYT and XLE have been pretty strongly correlated.
Okay, yeah, I'm going to build that portfolio right now real quick, and we'll look at that.
All right.
So here's just for October. This is if you've got a 50% position in each that you're basically keeping rebalanced. And so that's what this chart rendering is. And it's down, but let's look at the behavior of these components here. So transports is outperforming the energy, and it is 0.67% correlated. Now let's take a look at for all of 2014. See how that changes the picture. Okay, XLE and IYT 0.7% correlated, so about the same.
But a little more correlated. They were a little more correlated in the past.
Yeah, well, and you could see this spread kind of opening up here.
Yeah.
In August and September, and it's basically kind of maintained that spread. So, and now let's clear it out and look at the lifetime. So since January 2nd of 2004, that's the inception of one of these ETFs, probably IYT. Let's take a look at the correlations now. So much higher, 0.93.
So something is different. Something has changed.
Yeah, they're less correlated.
And I'd say there's been a shock to the energies ETFs, or energy components to that ETF that have caused the divergence.
Yeah,
we haven't heard about any railroads or transportation companies having a hard time, but we've all heard that Saudi Arabia is selling oil on the cheap. So,
well, it looks like the transports is kind of getting close to making a new high. XLE, nowhere even close. And I also want to bring that up. Like utilities is breaking out to new highs, and this is almost like a cup and handle shape here on the utilities. And I mean, this to me is like a really important detail. It's like what's making new highs right now, despite the volatility that's come into the market. Mm-hmm. Biotechs right there making a new high. The ITB, not so much. Turkey, not so much. But remember, we sorted these by performance for the month. Let's sort by performance for the year. And see who's making new highs for the year. EPI. It's up a lot. I mean, it's not a new high yet, but it's up a lot for the year. I think this is an India ETF. Yeah, Wisdom Tree India ETF. So pretty liquid. It's 3 or 4 million shares a day average volume. Here's the utilities. Here's the treasuries up near the top of the list of for the year. IHE pharmaceuticals. This is a pharmaceuticals ETF. IBB is the biotech. This may be Thailand, which is not necessarily going to make a new high. Yeah, Thailand.
Man, interesting. India and Thailand at the top.
And here we go. This is healthcare. Wow, it is right there at the highs. Just real quick, take a glance over here. Yeah, healthcare spider. There's Turkey. There's the transports. QQQ. And so, you know, despite doing pretty well for the year, the QQQ sold off really hard. And so it's not up to making a new high. And as you'd expect, almost right next to the QQQ is the XLK. So this is the Spider Select technology sector. The QQQ is the Nasdaq 100. So anyway, yeah, let's move to the next topic, which was I wanted to compare SPY. So here's SPY for the year. I wanted to compare this graph to the Nasdaq market top, because this kind of frothiness coming into the market, and I mean even this shape, sort of these little zigs and zags here, and then you know this a much bigger break happening. And so I wonder, like, did this big shock break the back of the bull market? And let me just kind of zoom this out a little bit to add some context here, and you can see it's like a bigger decline than what has happened in a long time. So as I'm zooming out, you can see like pretty ferocious, and we've had declines like this in the past that just really set the stage for the next move higher. The 2011 shock, which ended with the MF Global bankruptcy, I guess on Halloween, and then the flash crash was a similar, really frothy period before the flash crash. When we're zoomed this far out, like you can still see it's really frothy at the top here, just like similar to right there.
What was the big bust on the flash crash? Who went out of business during that time?
I don't think anybody went out of business, but there was the big Waddle and Reed trade. I don't know if it was a fat finger trade or it was kind of a scapegoat.
Okay, they still had a scapegoat.
Yeah,
there's always a scapegoat, right, on all of these things. What's the scapegoat this time? Ebola? Yeah. Is it Ebola? Is that the scapegoat?
Maybe. All right, let's. Since you brought it up, let's see what our Ebola penny stock indicator is saying.
I had to bring it up.
So here it is. Let's zoom in. Get it about that much. So Thursday night, news comes out. Ebola is the top hashtag on Twitter. News comes out. There's a patient in New York with Ebola, and the market had kind of an overnight scare. Well, our Ebola penny stock indicator, which is IVIO and Lake, a 50% allocation to each. It's down on the news. So this is a theme that's kind of running out of steam.
So it's not likely to be Ebola then. We're kind of backing off on that.
Yeah, it's real hard to say. I mean,
Amazon's earnings could have been Amazon. I don't think so. I don't know. But I'm very curious to see what comes out. I'm pretty sure there will be a press release of some sort that will pin this market downturn on something specific. Somebody will find a reason for this.
Right. So, like, is there another Enron crisis brewing behind the scenes? Or, if you remember in 1998, it was long-term capital management.
We'll see.
Yeah, we'll see. Okay, so back to the Nasdaq. Oops, there we go. I'm just going to kind of zoom in on the market top, and I mean, this is kind of the picture I wanted to show. Let me zoom this in a little bit more. I mean, you remember those zigs and zags I was talking about? So we're looking at, I want to be looking at about 10 months of data, and I guess this is kind of close to that. So maybe let's zoom it out just a little bit. So the first thing I want to point out is, like, on the y-axis here, these numbers are huge. They're like twice the magnitude of the numbers we saw on SPY, up to and including like this big shock right here in April of 2000. I mean, I guess I'm kind of likening this big shock to the shock that we just had in SPY. And again, like, this is the Nasdaq in 2000. So this is in the late 90s. This is the .com boom. And you remember those little zigs and zags? I mean, it almost looked just like these. And so we've got a 20% magnitude down move. It happens like over a week, like just almost straight down, and then a fierce bounce. And you know what? The S&P 500 is recovered, is retraced more of the drop than the Nasdaq is here. So what we're showing here on the Nasdaq, this is like maybe like a 40% retracement, and with SPY it's much bigger than that. But I want to kind of play this forward a little bit and just show that, when the market topped, I mean, this was the peak of the market of the .com boom right here. The Nasdaq like almost 5,000. Okay. It took, the volatility kind of went out of things after this big shock. There's a huge volatility. It made kind of a lower high and a lower low, but then it kind of calmed down for a little while. And, but the back was broken on the market. And, as I play this forward, you can see that, a bear market was born, but was just in its infancy back here in April when that big shock happened. So I wonder, are we seeing a similar thing playing out now? And maybe as QE3 is coming to an end, we're sort of like maybe kind of running out of gas or running on fumes.
Well, I don't know if it's about gas or fumes, but if the quote-unquote rules have changed and the big money sees a need to reverse its strategies and maybe go off into something else, I believe that's what causes these things. You have a shock that signals, hey, game over, and then it's time for everybody to reassess their strategies and reallocate their funds. And that's what you see here. These big hedge funds don't liquidate overnight unless something bad happened, right?
Good point.
Over time,
they're exiting the sector through this, through this whole entire space in here. And we did see, here I'm sure there was just some huge, crazy IPOs. We just had the Alibaba IPO near the top of the market in 2007. I believe. There was a bunch of huge private equity IPOs. Trying to think of the names of some of them. It's slipping my mind, but I mean, just huge IPOs, and they fell like 90% from the IPO. A lot of them. So anyway, these are very market savvy operators when you're talking about those private equity companies. Mm-hmm. So for them to be selling basically at the market top, really smart stuff, and maybe we're seeing a similar thing with Alibaba. I don't know. But anyway, I just wonder, like, is this kind of the scenario we're going into? So if something like this is going to be playing out, then we had this big shock. Maybe we'll make a lower high and a lower low. Maybe we won't make a lower low. But the point is, I expect the volatility to kind of come out of things for a little while. So we'll see how it plays out. Let me just flip back to the SPY one more time. Now that this is, we've kind of seen this perspective, and just kind of close on that note. There we go. So there it is. And it has been a long bull market. So so this is more like a 60% retracement than a 40% retracement, like we saw in the other in the Nasdaq. But I mean, here, let's just go to the beginning of the bull market and look at the whole thing real quick to put it into perspective. So everybody probably knows this date, March 6th, 2009. Market bottom. So there it is. We're looking at a compound annual growth rate of almost 23%. So if you made 23% every single year since the market bottom, this is what it looks like. And I mean, you didn't make 23% year in and year out, but like that's what the CAGR number is. It's a hypothetical number that if you had the 23% every year, you'd move from this bottom line to this top line.
It's a straight line.
It's a straight line. That's right. So I mean, these are huge numbers. I mean, if we could all just make 23% a year, that's really great, but it's not sustainable. So, or maybe it is nominally, right? So anyway, so that's kind of the takeaway here. Is maybe we've seen the back break on the bull market, and that view is reinforced by the energy sector kind of leading to the downside, and the utilities sector leading to the upside. So when we see these defensive stocks taking the lead, I mean, what's the growth story there? I mean, maybe a little bit in healthcare and medical devices and pharmaceuticals, but when it comes to utilities, you're going to cold call some client and you sell them on the growth story of utilities. I mean, these are not the makings of a bull market. So
it looks like the rules have changed.
Yeah, and the bull market happened, right? So there it is. Anyway, thanks for watching, guys. Please subscribe to the video or to our channel, and if you like what you see, we're on Twitter, putting out more of this kind of content at Portfolio WS on Twitter. Thanks.